Tax season just closed. April 15th came and went. And if you are over 65 or if someone you love is, I need you to stop whatever you are doing right now, because what I'm about to tell you is not in any newspaper, not in any government mailer, and not in anything the IRS is going to send to your door. According to data from the National Council on Aging, older Americans leave an estimated $58 billion in legal, eligible benefits unclaimed every single year, not because they are dishonest, not because they are careless, but because the system is specifically designed so that the people collecting your money have absolutely zero financial incentive to tell you that you do not have to pay it. $58 billion every year, gone. If you are watching this and you are not subscribed, hit that button right now. Because this channel is where I say the things that the official sources will not. My name is not important. What is important is that I have spent years sitting inside these systems, reading the policy language, watching how the gaps between what the law says and what people actually do costs real families real money quietly, invisibly, year after year. 5 bills, 5 things you may be legally excused from paying. Let us get into it. Before I get into the 5 bills specifically, I need you to understand something that most financial content completely skips over, because without this context, the individual bills feel like isolated tips. They are not. They are symptoms of the same structural problem. Here is what that problem looks like. There are entities whose entire operating budget depends on collecting money from you. Your county, your state, Medicare, the tax preparation industry. These are not villains, but they are institutions with a very specific financial incentive, and that incentive is not to volunteer information that reduces what you pay them. Think about it this way. Your county assessor's office knows exactly when you turn 65. That data exists. They have your birth date on file. Do they call you and say, "Congratulations, you now qualify for a property tax freeze"? In most counties across this country, they do not. Every dollar of exemption they grant you is a dollar removed from their budget. The silence is not malicious. It is structural. Now, and I want to be fair here, because this channel does not do one-sided analysis. Some states have genuinely improved. Colorado expanded its senior property tax relief in recent years. Minnesota has made meaningful changes. A handful of counties have started proactive outreach programs. I acknowledge that. That is real progress. But here is what the data tells us. Those are exceptions. The default in most jurisdictions is still silence. And the result, that $58 billion number I opened with, unclaimed, every single year. Here is what makes this moment particularly urgent. Tax season 2026 just closed. If you are watching this in May or June, you have roughly 10 months before the next filing window opens. 10 months to understand what you missed, correct it, and walk into next April prepared. That window starts right now. And it starts with Bill number 1, a law signed on the 4th of July last year that most people still fundamentally misunderstand. On July 4th, 2025, the President signed what is officially called the One Big Beautiful Bill Act into law, Public Law 119-21. And buried inside that legislation is a provision that affects every single American who is 65 or older. It has been described in headlines as no tax on Social Security. I need you to understand right now that description is incomplete. And if you act on the incomplete version, you may miss the actual opportunity. This is not a Social Security exemption. It is something called the senior bonus deduction. And the mechanics of how it works are more powerful and more nuanced than any 30-second news clip will tell you. Here is what the law actually says. Starting with tax year 2025, the return you filed this past April, every individual who is 65 or older by December 31st receives an additional deduction of $6,000. If you are married and both spouses qualify, that number becomes $12,000. This deduction does not replace anything you already had. It stacks on top. And this is where I need you to slow down with me for a moment, because this stacking effect is the part that changes the math completely. Before this law, a single filer over 65 already received the standard deduction of $15,750, plus an additional senior deduction of $2,000. Now you add the new $6,000 bonus on top of that. The total deduction available to a single senior in 2025 is $23,750. For a married couple where both spouses are 65 or older, that number reaches $46,700. Do you understand what that means in practical terms? A couple bringing in $90,000 in gross retirement income between Social Security, pension, and modest investment income could reduce their federal taxable income to a level where their total federal tax bill approaches zero, not because of loopholes, because of the law as written. Now, I promised you opposing views, and I am going to deliver one right now that most channels will not touch. The Tax Policy Center, a nonpartisan research organization, has estimated that fewer than half of all older Americans will actually benefit from this deduction. The reason is straightforward. Many lower-income seniors already have a federal tax liability of zero before this deduction even applies. You cannot deduct your way below zero. So the group that benefits most, in my assessment, is the middle seniors with income between roughly $40,000 and $120,000 annually. If that is you, this deduction was written for you. There is one more thing I need to say plainly, and I want you to write this down. This deduction is temporary. The law as currently written applies to 2025, 2026, 2027, and 2028. 4 years. After 2028, unless Congress acts to extend it, this provision expires. Given the current budget environment and the deficit implications, the Joint Committee on Taxation estimated this costs $91 billion over 4 years. Extension is not guaranteed. You have 3 filing seasons remaining. 1 just passed. The action here is simple. If you use tax software, it will ask your age and apply this automatically, but verify it appeared on your return. If someone prepares your taxes, ask them directly, did you apply the senior bonus deduction? If they hesitate, that hesitation is information. And that brings me directly to bill number 2, the one where I find the most consistent and most unnecessary overpayment happening right now. Let me ask you something directly. When you think about your Social Security benefits and taxes, which of these 2 beliefs feels true to you? Either Social Security is always taxed or Social Security is never taxed. I have talked to enough people to know that one of those 2 beliefs is sitting in the back of your mind right now. Both of them are wrong. And the gap between the wrong belief and the correct one is costing people real money every single month. Here is how Social Security taxation actually works. The IRS uses a number called your provisional income to determine how much of your Social Security benefit is subject to federal tax. Provisional income is not complicated. It is your adjusted gross income from other sources, plus any tax-exempt interest you receive, plus 50% of your total Social Security benefit for the year. If that number comes in below $25,000 and you are filing as a single individual, 0% of your Social Security is taxable. None of it. For married couples filing jointly, that threshold is $32,000. As your provisional income climbs, more of your benefit becomes taxable up to a maximum of 85% for higher income filers. And here is something worth pausing on. Even at the very top, 15% of your Social Security benefit is always, permanently, completely tax-free. The law has never touched that 15%. Now I want to talk about something that I believe is one of the most quietly damaging financial habits among retirees in this country. When millions of Americans first filed for Social Security, they checked a box or completed a form called the W-4V, instructing the government to withhold federal income tax directly from their monthly benefit check. 7%, 10%, 12%, sometimes 22%, taken out automatically before the money ever reaches them. Many of those people checked that box years ago. Some did it out of caution. Some were told it was the safe thing to do. And then they forgot about it entirely. Here's what that actually means. Every month, the federal government is holding a portion of your money. That money earns you nothing while it sits there. No interest, no return, Zero. And then in April, if you remember to file, some of it comes back as a refund and people feel good about that refund. They treat it like a bonus. It is not a bonus. It is your money. You gave the government an interest-free loan for 12 months and called it a win. Now, to be fair, there is a legitimate reason some people choose to withhold. If managing a large tax bill in April creates genuine financial stress, spreading the payment across monthly withholdings is a reasonable cash flow strategy. I am not telling you never to withhold. I am telling you to withhold the correct amount calculated against your actual provisional income and not $1 more. The fix is a new W-4V submitted directly to the Social Security Administration, adjusting your withholding rate to match what you genuinely owe. Bill number 3 is the one that makes people angry, not frustrated, angry, because the money involved is significant, the solution is simple, and the only reason most people are still paying is that nobody told them they had a choice. Let me tell you about a situation I have seen play out more times than I can count. A woman, 67 years old, lives in Illinois. Her income is $42,000 a year from a pension. Her annual property tax bill is $8,400. She owns her home. She has owned it for over 20 years. And for 4 consecutive years, 4 years, she paid every dollar of that bill without question. What she did not know is that the state of Illinois offers a program called the Senior Freeze. It locks your property's assessed value at its current level, meaning that even as her neighborhood gentrified and home values around her climbed, her taxable assessment could not increase. Based on her income and her home's value, her estimated annual savings would have been approximately $1,200 per year. 4 years, $4,800. Gone. Not taken illegally, not stolen, simply never claimed because nobody told her the program existed. Now zoom out with me. In April of 2026, reporting estimated that over 1 million seniors in Texas alone may be at risk of missing or losing their school district tax exemption, a benefit that freezes school property taxes at the level you paid the year you turned 65, regardless of how much your home's value increases afterward. I want to be transparent. I cannot independently verify that precise figure in its entirety. But even if the real number is a fraction of that estimate, we are talking about a systemic failure affecting hundreds of thousands of households. Here is what you need to understand about how property tax relief for seniors actually works, because most people think there is one program. There are 3 distinct structures, and they serve different people. The first is income-based relief, sometimes called a circuit breaker. Kansas, for example, refunds 75% of property taxes actually paid for qualifying low-income seniors. This category is designed for those on the tightest fixed incomes. The second is a flat exemption, a fixed dollar amount removed from your home's assessed value before the tax rate is applied. Alaska exempts up to $150,000 of assessed value with no income test whatsoever. Louisiana exempts the first $75,000 of home value for residents 65 and older. The third, and the one I believe is most consistently overlooked by middle-income homeowners, is the age-based freeze. Texas freezes your school district tax dollar amount the year you turn 65. No income limit, no asset test. Your age is the only qualification. New Jersey's Stay NJ program can reimburse up to 50% of your property taxes with a cap of $6,500 annually. Now here is the opposing view I promised you. Several states have genuinely expanded their programs in recent years. Colorado and Minnesota have both broadened eligibility. Some counties have begun proactive outreach. Progress is real in some places. But here is the thing that does not change regardless of your state. These programs are almost never automatic. Your county does not look at your birthday, see that you turned 65, and apply the discount. You have to file. And in most jurisdictions, that filing window opens January 1st and closes sometime in early April of the year you first qualify. Miss that window, and you wait another full year. Nobody sends you a reminder, because every dollar they exempt is a dollar out of their budget. 2 questions. Write them down. Call your county assessor and ask them directly. First, what property tax relief do you offer for homeowners over 65? Second, which of those programs are based on age alone with no income requirement? That second question is the one most people never think to ask. And the answer to it has been worth thousands of dollars per year to people who had assumed they earned too much to qualify for anything. On July 4th, 2025, a law was signed that created what Medicare calls an income-related monthly adjustment amount. Most people call it IRMAA. And I want you to think of it exactly the way it sounds, like something that quietly moves into your house, sits down at your table, and starts eating your food without ever introducing itself. Here's the technical definition. IRMAA is a surcharge, an additional amount added on top of your standard Medicare Part B and Part D premiums that kicks in once your income crosses certain thresholds. For 2026, that surcharge ranges from $1,148 per person per year at the lowest tier, all the way up to $6,936 per person per year at the highest tier. Those numbers are per person. If you and your spouse are both on Medicare, double them. But before I get into the surcharge itself, I want to address something that affects almost everyone watching this, regardless of income. Medicare Part A. The portion that covers hospital stays is supposed to cost you $0 in monthly premiums if you or your spouse worked and paid into the system for at least 40 quarters. That is 10 years of work history. The vast majority of Americans over 65 have done exactly that. Yet some people are still paying a Part A premium simply because of confusion about their work record or their spouse's record. That is the first thing to verify. Pull your Social Security statement and confirm your quarters of coverage before anything else. Now, back to IRMAA, because this is where it gets structural. Medicare does not look at your current income to set your premiums. It looks at your tax return from 2 years ago. For 2026 premiums, Medicare is reading your 2024 tax return. That is the 2-year look-back rule, and it creates a trap that I have seen catch people completely off guard at exactly the worst possible moment. Here is the scenario. You are 64 years old in 2024. You are still working. Your modified adjusted gross income that year is $280,000. In 2025, you retire. Your income drops to $65,000. But when you enter Medicare in 2026, the system does not see your current retirement income. It sees your 2024 return. It places you in a high surcharge tier. And it begins quietly deducting that surcharge directly from your Social Security check every single month. No letter explaining why, no phone call. Just a smaller number arriving in your account than you expected. Most people assume the deduction is correct and move on. It may not be correct. And there is a specific federal form designed to address exactly this situation. It is called Form SSA 44. The official title is Medicare Income-Related Monthly Adjustment Amount Life-Changing Event. And what it allows you to do is present your current reduced income to the Social Security Administration and request that they recalculate your premium based on your real financial situation rather than a 2-year-old snapshot. Now here is what the video you watched before this one probably did not tell you. There are 8 qualifying life-changing events that make you eligible to file this appeal. Most people only hear about 4. Let me give you all 8. Work stoppage, work reduction, marriage, divorce or annulment, death of a spouse, loss of income-producing property, loss of pension income, and employer settlement payment. If any of those events occurred in your life within the past 2 years and your income is now meaningfully lower than what appears on your most recent tax return, you have grounds to file SSA 44. The process takes between 30 and 90 days. If your appeal is approved, the adjustment can be retroactive to the date the life-changing event occurred, meaning you may receive a refund for premiums you overpaid during the processing period. One critical procedural note. If you are married and both you and your spouse are enrolled in Medicare Part B, each of you must file a separate SSA 44, one form per person. This is a detail that causes appeals to stall or be processed incorrectly. Now I want to give you the honest counterpoint, because this channel does not cherry pick. Not every income reduction qualifies. If your income dropped because of a one-time capital gain that inflated a previous year's return, or because of market performance, those are not qualifying life-changing events under the current rules. You cannot appeal on that basis. You wait for the 2-year look-back to naturally catch up with your current situation. And there is one more trap that almost nobody mentions. Your modified adjusted gross income for IRMAA purposes includes tax-exempt interest, the kind generated by municipal bonds. Many people assume that because municipal bond interest is federally tax-exempt, it is invisible to Medicare. It is not. It counts toward your MAGI for IRMAA calculations, and ignoring it can place you in a higher surcharge tier than you realize. Bill number 5 is the shortest section of this video, but do not mistake brevity for low importance. Because what I am about to describe costs millions of Americans hundreds of dollars every single year, and the solution takes less than 15 minutes to act on. Every year, millions of Americans over 65 walk into a storefront tax office, a recognizable chain, a familiar name and hand over somewhere between $200 and $500 to have a retirement tax return prepared. A return that, in many cases, involves 2 Social Security statements, a pension form, perhaps a handful of investment documents, and nothing more complicated than that. And every year, those same people qualify by age, by income, by the simplicity of their return for a free alternative that the federal government itself funds, trains, and certifies. It is called the Tax Counseling for the Elderly Program, TCE. It is an Internal Revenue Service program specifically designed for taxpayers 60 and older, with a particular focus on the exact questions that define a retirement tax return, pension income, Social Security taxation, required minimum distributions, retirement account withdrawals. The questions that a general tax preparer may handle competently, but that a TCE volunteer handles constantly, every single season, for people in exactly your situation. The largest provider of TCE services in the country is AARP Foundation Tax Aid. And I want to give you the specific numbers because specificity matters here. As of the 2026 filing season, TaxAid operated at over 3,600 locations across all 50 states and the District of Columbia. More than 28,000 volunteers, every one of them IRS certified, annually prepared returns for over 1.7 million people this past season alone, securing a combined total of $1.3 billion in refunds. You do not need to be an AARP member to use this service. That is a misconception that turns people away unnecessarily. Now here is the honest counterpoint I promised you. And I mean this genuinely. If your financial life is complicated rental properties, a business you are winding down, a significant estate, alternative minimum tax exposure, pay a qualified professional. Pay them well. That expertise is worth every dollar in those situations, and AARP TaxAid will tell you the same thing directly. They publish clearly what they can and cannot handle. But if your return is straightforward, the law has already built you a free, qualified, federally certified option. And what I am about to show you next is why understanding all 5 of these bills together is worth more than understanding any single one of them alone. I want to show you something that I have never seen explained clearly in any mainstream financial video. Not once. Everything we have covered today, the 5 bills, the deductions, the appeals, the exemptions, most people treat these as separate items on a checklist. They are not. They are connected. And when you understand the connection, the math changes dramatically. Here is the chain. Follow it carefully. You are 72 years old. You have a traditional IRA. You give $25,000 directly from that IRA to your church or a qualifying charity. That is called a qualified charitable distribution. That $25,000 never appears as income on your tax return. It is excluded entirely, not deducted, excluded. That is a more powerful distinction than it sounds. Because that exclusion lowers your modified adjusted gross income. Lower modified adjusted gross income means a smaller portion of your Social Security benefit becomes taxable. That is bill number 2. Lower modified adjusted gross income also means you may drop into a lower IRMAA tier or exit IRMAA entirely. That is bill number 4. And lower modified adjusted gross income means your senior bonus deduction phases out less aggressively. That is bill number 1. One action, 3 simultaneous effects. For 2026, the qualified charitable distribution limit increased to $111,000 per person indexed for inflation. If both spouses qualify, that number doubles. This is the conversation your tax preparer should be having with you. If they are not, you now know to ask. Let me bring this together fast. Bill number 1, the senior bonus deduction, up to $6,000 per person, stacking on top of everything you already had. 3 filing seasons remaining. 1 just passed. Bill number 2. Your provisional income determines how much of your Social Security gets taxed, and your W-4V may be giving the government an interest-free loan every single month. Bill number 3. Your county assessor is sitting on a list of exemptions and freezes that they have no legal obligation to tell you about. 1 phone call changes that. Bill number 4. IRMAA may be charging you based on income you no longer earn. Form SSA 44 exists specifically to correct that. Most people never file it. Bill number 5. A federally funded, IRS-certified, completely free tax preparation service exists for people exactly like you. Over 3,600 locations. You are probably within driving distance of one right now. Now I want to hear from you. In the comments below, tell me which of these 5 did you genuinely not know before today. Just type the number 1, 2, 3, 4, or 5. No judgment. Your answer tells me exactly what to cover next. If this opened something for you, send it to one person in your life who is over 60. Not because I need the views, because that person is statistically likely to be leaving money on the table right now that legally belongs to them. I will be back the moment anything changes, especially any movement in Congress around extending the senior bonus deduction beyond 2028. That is the story I am watching most closely right now. Do not miss it.